We know our property markets have been going gangbusters so far this year, with double-digit capital growth in almost all our capital cities. But what's ahead? Are first-home buyers being priced out of the market by rising property values? Are we really going to go into a period of housing shortage in Australia? Well, there's some of the questions I'm going to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, in this week's Property Insider Chat. We're also going to talk about how the Sydney property market's coping with the lockdowns and the ongoing speculation about interest rates and what the Reserve Bank had to say about that. Hi, Andrew.
Yes, hello, Michael. Good to chat again, as always. There's always something happening, isn't there? The week is always filled with news in property, one way or the other.
Yes, it has. And lockdowns don't seem to have been able to slow down Australia's property markets yet. So as always, let's start with the auction clearance rates, which is giving us an idea of what's happening on the ground. And then we got those other interesting research matters that My Housing Market has done to discuss.
Yes, look, second week of July, of course. Typically, we'd be in the depths, well, we are in the depths of winter, but in terms of the housing market, it really is the depth of the annual housing market activity levels, except, of course, for January. But no sign of that. Now, we are typically seeing, of course, some seasonal impacts with fewer properties offered for auction compared to certainly June and May. But numbers are still at record levels, Michael. In fact, we broke the record again on Saturday for the number of auctions conducted on a July Saturday. That was a new record. It passed the previous record, which was set the weekend before. So numbers, even though they are lower than where they were in June, which, let's remind everybody, was another record month for auctions, we're still setting records quite clearly in July at the moment. And clearance rates really held their own last weekend, Michael, compared to the previous weekend. The smaller markets are still getting quite high clearance rates, above 80%. Sydney came back, and of course, it's at its year lows in terms of clearance rates, but there's a very good reason for that. And that, of course, is the COVID shutdown, which is obviously encouraging a number of vendors to withdraw their properties before auction because of the physical restrictions. Not so much as a reason because they're concerned about the market dynamics. It is about those restrictions. But what's different to this year compared to last year's lockdown in the auction markets, Michael, is the proportion of withdrawals is very low compared to what we saw in May last year. Withdrawals were about 22% of reported auctions on the weekend in Sydney. That kept the auction clearance rate similar to the week before, 76.6%. If we had the normal level of withdrawals, that is, if we had about a 10% withdrawal level, which is normal, we would have had a clearance rate of in the mid-80s. The underlying strength of the market is still quite clearly there. It is a disruption because these auction numbers in Sydney do reflect plans that were made 4 or 5 weeks ago, which of course was prior to COVID. So we will be seeing the number of auctions coming into the market now decline because of those physical restrictions. But it'll be interesting to see just how much they do decline. And of course, that is about also the fact that it is the midwinter market. But the longer the shutdown period goes, of course, the fewer auctions we will get in the market, just because of those physical restrictions, Michael. But there's nothing in our auction markets to suggest that the cycle is anything but easing gradually, which is what we've discussed. Interesting to see if we get the usual rebound in the spring market, which will start to become evident in those non-shutdown markets over the next month or two, Michael, when we will start to see forward projections of auction numbers from late August into September. And it'll be interesting to see if those numbers start to rise again, indicating, of course, that the market still has plenty of upside. But the other point to the auction markets, Michael, which I thought was interesting, was that there's really no sign of an easing in median auction prices either. Melbourne was down a little bit. It's been tracking, its median auction house price has been tracking at around about $1 million per weekend. It was just under the million on Saturday. But Sydney median house prices for properties sold at auction was 1.6 million, Michael, which is again well ahead of higher than the previous weekend, and well ahead, of course, of the same period a year ago. So no real indication of lower prices, and usually we do see that in the winter months because you see a lower proportion of higher priced properties being offered for sale in July.
If anything, we know from finance approvals, which are a leading indicator, that there's more people out there going to be looking for property over the next little while. So it's likely the property markets are going to boom again. And of course, we learned from previous experiences from last year that once the lockdowns opened up
Yes.
again, people get back to normal very quickly. We've become very resilient.
Yes, and I think that reflects the fact that this isn't a fundamental issue in terms of the dynamics of the housing market. It's about just really restrictions, that it doesn't impact confidence. It doesn't impact anything else other than the fact that you can't get out in normal circumstances and buy and sell property. It is about that restrictive element rather than the underlying force. And I think the confidence issue as well in terms of the economy is part of that, Michael. I think people realise that this is a nuisance, and of course it's serious in terms of its health implications, but in general terms it's a nuisance, and once we can get on top of it, then we get back, and as Australia has shown, quite quickly, not just to the housing market, but also quite quickly to economic growth.
Not just the economy doing well, people are feeling secure about their jobs, Andrew, and when they do, they're going to make those big decisions. Now, we know that building approvals for houses surged over the last year, and they were fueled by the federal government's Home Builder Initiative and other initiatives to get the building industry under control. But I understand that some of your research at My Housing Market suggests that there's an undersupply of properties looming.
Well, I think we've really been saved from a very visible undersupply, Michael, because of shut borders. The debate is now getting a bit more rational about the impact of migration on the housing market. We know it's a much more longer term impact, particularly on price outcomes. That tends to be more short-term drivers influence house price outcomes, and that's of course interest rates and the economy and confidence. We've seen a collapse in international migration as we've never seen it before, and yet housing markets are steaming ahead. There's plenty of demand there, Michael, and it's too much demand in the sense that it's pushing up prices at near record levels. Interstate migration can be a factor, and we're seeing that, of course, in the Brisbane market, where very strong interstate migration from southern states, particularly Melbourne or Victoria and Melbourne, is creating a lot of demand for property in that market, and keeping prices and rents certainly in an upward trajectory. But the building boom is over in terms of what's been generated by Home Builder. Of course, Home Builder is finished now, and that was for predominantly houses on the fringe, took advantage of that policy. That policy is finished. We're still getting high levels of building approvals coming through as that works its way through the food chain of building, Michael. But we've certainly come off our peaks now in terms of the number of approvals. They're now falling, still quite high, but this has been very much about house approvals rather than unit approvals. We've seen unit approvals picking up a little bit, Michael, but from a very, very low base in terms of approvals for houses on an annual basis. We can see that we're now at record levels for that, but we know that's going to fall away because of the end of the Home Builder policy. So this is really an artificial bounce, but when we look at total dwelling approvals in terms of the trend, we're still around 20% down on our previous peaks. And that's because of the collapse in the unit market, which had a lot to do with finance restrictions to investors. But going forward, I firmly believe that we will see shortages of housing once, as I said, we've passed these stimulus package initiatives, and it's still tough to get developments off the ground for units and medium density. And I think that will continue to put upward pressure on prices and rents, notwithstanding that there's been probably put off to some degree because of the lack of migration at the moment, Michael.
And when the borders open and migration starts again, it's going to take a long time to get those new high-rise apartment blocks off the ground. It's much quicker to build a house. You can do that in 8 to 10 months, but to get the approvals, to get the pre-sales, it looks like we're going to have a shortage of properties in the areas where a lot of people are going to want to start moving back as our borders open.
That's right. And you only have to look at Sydney, Michael, to see how you can have significant disparities in the supply chain for property that don't match where people and in what people are wanting to live in. And we can see Sydney quite clearly was an underperformer in terms of the new building, particularly for houses, of course, that came as a result of the Home Builder allowance policy. And that's because Sydney, of course, is restricted. It's further out to the fringe than really any of the other capital city markets. It's very much a higher density destination. Michael, people don't really want to live generally well, certainly a larger proportion of people would prefer to live in established suburban locations in Sydney compared to Melbourne and Brisbane, where there's plenty to offer still on the fringe, and Perth. And that means that Sydney is restricted in terms of supply. It's Australia's biggest city. It is a key destination for international migrants when we don't have border closures. So I think this has been a real problem, Michael, going forward. And I know there's a lot of issues here, and that is how we actually create supply for our housing markets. There are a lot of particularly political roadblocks to efficient supply. Planning laws are very much about state governments and local governments, and then it becomes that not in my backyard issue, which restricts development. Now, I think we can look for a much better balance in that conversation and in policy setting, because there's nothing worse really for if our communities start to run out of property. We are clearly on the data undersupplying our markets, and you can't, obviously this won't be revisited, the home builder scheme of last year. That was really about creating jobs rather than creating supply of houses. And we can see that those issues, it's very much the demand side that seems to obsess policymakers. And we can see that when APRA moved into the market, concerned about demand and higher prices, and the outcomes perhaps from an overbalance that they thought was going to come through higher interest rates, which of course never happened. But the long-term consequences for that was that it took a lot of demand from investors out of the market, which meant fewer investment properties. And we're seeing rents going through the roof in a number of capital city markets now because of that lack of investor activity. So it's not just new building, it's established as well. So you've got to be careful what you do on the demand side if you're not matching it on the supply side, Michael. And that's the problem. We haven't been doing that, and we need to do that. Believe me, that is a fundamental issue in Australian housing market. Nothing to do with high house prices or interest rates or any of those things that generate all the conversations. It's about not having enough houses to go around. And of course, we wouldn't have that skyrocketing house price environment, or certainly we'd have it to a lesser degree if we had more properties for people to choose from. I think that's clearly the answer. I know it's not easy, but governments aren't there to do easy things, if you know what I mean.
Now, I know my housing market's also been doing some research about affordability. And we know
Yes.
first home buyers, they were a significant force in our property markets
Yes.
over the last year. As we already said, they've been buoyed by low interest rates, the federal government, the state government incentives, home builder, stamp duty concessions. But Andrew, what's happening to first homeowners now that property prices have increased so much?
We knew that as prices continue to increase, it would start to sideline or marginalise first home buyers. They don't have a trade-in to bring into the property market. That's why they're first home buyers. So they can't keep up with prices with their trade-in. They have to save harder as prices rise. And in a low-income environment, that, of course, is difficult. So we are quite clearly seeing the consequences of that. We've seen a sharp decline in housing affordability. The My Housing Market First Home Buyer Home Loan Affordability Index has risen consistently. This is a quarterly index that's run every month, has risen consistently over the past few months, and now it's at its highest level for some time. And we saw that the big markets, particularly Melbourne and Sydney and Queensland, all increased their unaffordability over the May quarter. And no surprise, of course, that New South Wales, with that big Sydney market, it declined the most. So the index actually rose. We've got to be clear here, a higher index means less affordability. And the index for New South Wales increased by 3% over the quarter, which is a very big increase, Michael. And that, of course, reflects the high price of Sydney's housing market and how difficult that is for first home buyers to get into. And look, the index measures the proportion of the average income that has to be paid for the average repayment of the average loan. And when we look at the comparisons between each of the states, Michael, in terms of affordability, we can see Sydney's well ahead of everywhere else there, with the highest level of unaffordability there in the index of 120.5 compared to the national level of 100. So it's 20% less affordable than the national level of affordability. So again, reinforces the issues to do with high prices and first home buyers. Of course, first home buyers are also tackling the constraints of more investors coming into the marketplace. And we will see, as we've discussed last week, Michael, with fewer loans coming through, the number of first home buyers will decline, although it still remains at quite high levels. It's coming from a significantly high peak, although not the highest we've reported, but it's certainly not far away now from 2009, but it will continue to decline as prices keep rising.
Once again, the Reserve Bank met. They didn't change interest rates. Nobody expected them to. But with the economy booming and more jobs being advertised, the media is out there again speculating about interest rate rises. But Reserve Bank Governor Philip Lowe came out and he shut down those
Yes.
predictions once again, didn't he?
That died a death last week, the predictions that interest rates from some. I think the Commonwealth Bank predicted that their chief economist, one of their leading economists, got a lot of media predicting that he believed that interest rates would increase in the third or fourth quarter of next year, which of course is well ahead of the Reserve Bank's predictions of 2024. Not quite sure on what basis those predictions were made. There's a lot of push from the banks at the moment for people to lock in interest rates. That's a marketing campaign, particularly the Bank of New South Wales has been conducting. But the Reserve Bank governor came out quite strongly and very unusually, Michael, because this was only really, he's only done a handful of these types of events where he's made a direct speech regarding interest rates and the outlook. And he quite clearly said that they're adamant that they still feel at best we're looking at 2024 before interest rates would rise. And he made the very salient point that we need to get inflation into that 2 to 3% band for him to even consider it. But and we're 1.5% at the moment, underlying inflation. He's talking about underlying inflation, and they acknowledge that inflation will rise over the next couple of quarters, as we've discussed, because of adjustments from the COVID, where particularly childcare building costs were held flat. But he said that that's not going to have an impact on underlying inflation. And the point that he made, that he still thinks that underlying, and that was a problem they had prior to COVID about incomes growth and inflation. And he thinks it hasn't been fixed. And to get to, and that was the other point, he needs a consistent period, not just a once-off quarterly result that'll fit into his 2 to 3% band for where to start thinking about it. He said that there has to be a consistent period of inflation above between 2 and 3% and incomes growth of between 2 and 3% before they even consider that. Now that we are talking almost years. So where the Commonwealth Bank comes from in saying that in just over a year's time, we're going to have higher interest rates, it just doesn't fit any of the logic from the Reserve Bank. And it doesn't fit any of the other logical arguments. And of course, with COVID now putting a question mark over the national economy, COVID in Sydney, and also some less than perfect data coming out of the US last week, which was of a concern. I think the Commonwealth Bank's just got ahead of the game here a little bit. And one's got to ask the question, what was the motivation behind these headlines of higher rates? We've seen a surge in people locking in fixed-term interest rates, not understanding that particularly the shorter-term, medium-term horizon is interest rates not to move. Just ask the Reserve Bank.
Well, a cynic may suggest that it's going to lock clients into a particular bank, because if you lock in for 3, 4 or 5 years, you're much less likely to shop around for interest rates with the competitors.
Yeah, and you have to pay if you do. So there's a disincentive, but you have to pay even whether you're with an existing bank. But they, of course, will give you the incentives to stay. It's a very cynical exercise, in my opinion. And as I said, we haven't had a peep out of the banks that were predicting that. Yes, Mike, you could almost set your watch, couldn't you, to when they're going to revise those forecasts. And it's as I said before, a very cynical exercise. And look, whatever the marketing agenda behind it might have been, it really is of concern to me that people will be making investment decisions based on what is clearly economic advice that is against that's been provided by our policymakers.
Well, we have difficulty working out what's going to happen in the next 40 hours when you're in lockdown, but the government actually made some efforts to work out what's going to happen in 40 years' time. So I'd like to have a chat with you about that next week when we have a look at the intergenerational report and see if we can make any sense out of their long-term predictions, Andrew.
Yes, good on you, Michael. Thanks for that.
Bye.